slowing yourself down. I'm not great at goal setting. Sometimes have the 5-year or 10-year goals, but 10-year goal for me is almost useless. What's actionable about that's tough. So I try to break my goals down a lot sooner, at most maybe a year.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall DeCleared. Let's go, baby. All right. Welcome back to the show. It's great to have you on again today. This week, we are talking with an operator in the multifamily space. As I've always promised, I want to bring operators on so that you can see what actually is happening behind the scenes on multifamily acquisitions and transactions in different asset classes as well. So we wanted to sprinkle in an interview with Kenneth Sumners of Sumners Capital. He is, like I said, an operator in this space. He's in the San Antonio market. So I know Kenneth well, and it's been great to see his business grow. He recently just quit his W-2 job so that he could get into real estate full time, literally a month or two ago. So it is great to see how he's evolved and some of the unique challenges that he's had making that shift from W-2 and some of the benefits, obviously, that he's gotten from doing that. And then the challenges from buying multifamily in the last 3 years. And so we talk about that a little bit, about some of his properties in a specific transaction. But overall, Kenneth is a good friend, and I'm glad that he is in this business full time. He's in San Antonio, so I get to see him on a regular basis in a lot of the groups that we're in. And I get to learn from him as well. So you're going to get a lot from this episode. If you're not investing in commercial or apartments or any kind of income producing properties, pay attention, listen, because you're missing out on some tax benefits and some strategies that you could be getting if you were investing passively in these deals, or if you actually want to go out and start doing these deals. This is the whole reason I started the show, was to teach how to do what Kenneth and I are doing, and or to get you to be able to learn how to invest in these deals passively. So yeah, let's dive right in. And as always, if you're getting something from the show, if you're getting some value, please go on wherever you're listening to the podcast or YouTube, whatever it is, rate and review the show. It helps us out a lot. And without any further delay, let's go. Let's jump in and talk to Kenneth. All right, Kenneth, welcome to the show, man. It's great to have you on. I know you and I know each other because of a group we're in San Antonio here. And so we might touch on that in a minute. But I wanted to ask you, I know that you just recently retired, right? You quit your W-2. So I wanted to say congrats first and foremost on making that shift. And I just wanted to see if you could walk us through the decision-making process you had to go through in order to make that jump. Kind of curious.
Yeah, sure. Thanks for having me on, Randall. Appreciate it. So yeah, the leap from full-time W-2 into full-time real estate was a big transition for me, as you can imagine. So I've been doing passive investing for a few years before I got into the active side of things. Started buying my own properties with the help of syndications and other passive investors jumping in. So I had been building that up, and I have 3 properties that I'm managing. And the time commitment on that was starting to grow quite a bit, and responsibilities were growing. My W-2 was, I was a manager of a network engineering division of a company, and that was important to me. I liked the people I worked with. I liked the projects that we were on, but the time commitment came to a head where my responsibilities were growing in both areas, and I had to choose. And I knew that my long-term strategy was real estate. So that was kind of the decision. At some point when the scheduling conflicts got to where it wasn't possible to do both, made the leap, and I'm doing full time. So it is funny that I was doing the 8 to 5 kind of gig for 17 years. And now my days are much more open and flexible. And that's kind of a scary thing in a lot of ways, because you don't know, making sure I'm focusing on the right things for my business.
Yeah, we're going to talk about that. So a couple things in there. One, it sounds like it was more of a time issue, more so than like the monetary, I guess, income has been fully replaced. Was that part of your decision-making process? Or was it like, I know that real estate's where I'm going, and even though I may not have fully replaced my income, I will soon enough or something? How did that weigh into it or factor into it?
Yeah, so I've got a family to support as well. My wife does work full time, so that's helpful for me financially, or for our family, it's helpful. But yeah, I was able to, in the first year of moving over to the active side of things, essentially replace my income from a career building up to it. And then my first year in real estate, I'm able to replace my entire income. So the writing was on the wall that financially real estate was the way, right? And so there's a little bit of residual income that comes in for asset management. It's not a lot, but it kind of pays for the business expenses, things like that. And then the acquisition fees at the beginning, when you become active, that's part of the process is once you close a deal, you tend to charge a fee to kind of pay for the acquisition process. It's a fair amount of work. That helped me to replace that kind of base income. The asset management fees, kind of ongoing fees, helped me throughout the process and essentially paying for the company for the business expenses of running these kind of things. And the thought is down the line, once we sell these properties, the equity that I've been able to structure for these, once we sell the property, the equity split is such that everybody makes their money, including the passive investors in a big way. So that's the 4 or 5 year you got to eat. So just kind of continuing to find ways to make it through this period.
Yeah, that's awesome. All right. So I wanted to ask you on the 4 or 5 year timeline you're kind of thinking about. Really, that was the same sort of shift for me. Instead of doing these short, quick hit sort of deals where I was flipping houses and that sort of thing and making chunks of money, to more of a long term, I'm going to be in this thing for the long haul. I want to hold things. I want cash flow nonstop. And so one thing I struggle with when I go to seminars or listen to a lot of syndicators at times talk about, it's not a conflict of interest, but it's almost like when you are investing for a certain return, like an AAR or a certain IRR return profile, your types of acquisitions are going to be different than if you were not IRR sensitive. Does that make sense? So do you ever look at deals now? And I mean, this market is completely different than it was a couple of years ago. But do you look at deals with a 10-year hold vision, or are you going to exit in 3 to 5 to 7 years now, maybe 7 years in this time, and cash flows are struggling a bit? And so it's really, like you said, you're holding these properties for the equity growth in the long term. Is that kind of the strategy?
Yeah, that's a great question. And it kind of comes down to investor expectations, right? So my thought is if I'm trying to get passive investors to invest in a deal, it has to be attractive. And so if I can come to them with a proposition that says we're going to hold for 50 years and you're going to get a 2% return and I can attract capital, great. We can do that all day long. A lot of times that doesn't attract capital, right? You can find a better investment. So the thought is, let's be the best investment for the risk-adjusted returns is what we're after. And we're trying to be top notch on that. So if I'm going to risk passive investor income in it, I've got to know that the passive investors will be there to fund that deal and help fund the deal, right? So I'm still looking at it similar to how we did even 2 years ago from what it was before in terms of the preferred return, the average annual return, or AAR or IRR metrics. And if those metrics haven't been explained that deals aren't meeting some of the 2 year ago kind of marks, then it's going to be hard to expect them to jump into a passive investment, even though a lot of the deals that I'm seeing are on sale. We're seeing a depressed market essentially, and it's kind of the buy the dip type thing, right? So this is a good time to buy, but unfortunately the cash flows that we're seeing in underwriting don't support the same model that we were before in terms of the distributions on a quarterly or monthly basis, right? And if they're going to say, hey, I'm not interested in the deal. In terms of the hold time as well, the 5 to 7 year kind of mark, a lot of times still investors do want to exit and get some kind of return out of it versus a cash flow play that might be much longer term, 10, 15 year kind of play. I think they're still wanting to date these people. Operators like me, they don't want to go into a 15-year relationship. They'd rather go into a 3 to 5 year investment and say, hey, let's get it out and then maybe do it again, right? So I think when you're building up as an active investor or you're talking to a newer operator, I think you're probably going to see shorter holds typically. Maybe a seasoned investor's been doing it 20 years. They might have some offerings for longer term plays because of the investor base is like, hey, I don't want to keep turning this money over. I'd rather just invest with you and your program and just hold it for however long it takes, assuming that deal can cash flow. But a lot of these deals do require some capital injection, right? When you hold them for 5 years, they're ripe for the next investor to come in and add new capital to it. And when you go and you're trying to just survive off of operational capital for all your repairs, the return metrics start to reduce. The returns are still okay, but yeah, the cash flow, you're living off the cash flow essentially instead of investor capital, if that makes sense.
Yeah, it does. Man, great response. I wanted to ask you something in there about you're still looking at the same things in the same type of way. So, but have you considered or are you changing your actual offerings? I don't know if you're doing 506Bs and that sort of thing, but if you can't talk about them, no worries. But hypothetically, are you changing if it was a 7 pref, 70-30 split? Are you considering changing those going forward because it's a different economic cycle, or are you sticking with it and your investors like that sort of thing?
Yeah. And good question. It's a matter of investor expectations. Again, it kind of keeps coming down to that.
Yep.
And at this point, that's the investor expectation. So it would be more difficult to change, especially knowing that I do believe that this cycle is short-lived, right? We're in this dip, and hopefully soon we're going to start seeing the rise again. So we're recording this kind of mid 2023, and we're still kind of in the midst of it. There's kind of a looming potential recession coming. What that might look like, we're not sure, but how fast will this rebound is everybody's question. And I get different responses from industry professionals that track this on a daily basis.
For sure.
It's all over the map. So we just don't know what's happening. But my thought is, the business model that I've done in the past has been tried and true. And that's really been the model that I think has worked over the past 10 years. So now looking forward 10 years, I want to stay in that pattern. And I think we can still find deals that work and fit that same mold today, even in this time. There are fewer and far between, and they might be distressed, but the thought is still having that same kind of return metrics are happening. But I have talked to investors and say, hey, if I brought you something that still had that same average annual return, but maybe we don't have the cash flow to back up the pref and maybe don't have any distributions, would you still be interested? And a lot of people still want distributions. So that's still important, even though it's kind of a small sliver each quarter or each month that might be coming in versus the upside at the end. It's still important to investors that they see that and think that sometimes correlates in somebody's mind to the deal still being a good deal, right? Even though that might not necessarily be the case.
Yeah, I can see that. It's like another touch point that they see validity for the deal, like you said. Yeah, I mean, that's kind of some of the guys that I've talked to, I've seen a shift. Some have always operated with like just a straight 80-20 split, right? Cash flows come in, whatever it is, it's 80-20. There's no pref. It's just like an 85-15 or something like that. So I just didn't know if you had seen some of that in the marketplace or if you considered doing something like that and had that conversation with some investors to get their feedback for that type, for that offering. So, okay. You mentioned a couple other things that I keyed in on, and you mentioned that it's kind of eating into your time, right? And so like the allure for real estate for a lot of people is like, hey, I'm just going to invest and, I'm going to have these passive, I'm going to own this property and this money's going to just come in. And the way you describe it is like, well, it takes a lot more time than you think to actually run one of these large deals, even if I have third-party property management. So can you speak to that just a little bit? What is time consuming once you own and operate 100 plus unit multifamily deal?
Yeah, and all three of my properties have third property management, and that's the only way to go if you're starting out. It's a way to leverage your time and grow in a more stable way. Some people that have started out with managing their own properties, and my time commitment, if all goes well, then I think the holy grail is to passively invest and just have mailbox money, right? That's my ultimate goal. On the active side, though, there is some time management that you need to go through. And where asset management in general isn't terribly time consuming, we take the asset management calls for each of the properties once a week. But there's also, of course, administrative things that are happening and all that. But a lot of it is mind share. When I left the W-2, it was amazing how much of that mind share went away. So even during the day, at night, whatever, you're thinking about two important things that are happening.
I agree with that 100%. What you're talking about as far as the mind share, just having multiple like real estate businesses I'm trying to work through. But yeah, just going from W-2. So maybe kind of continue on that thread with the mind share of not having to think about two different jobs and when you're going to sleep at night.
Yeah, so I was really surprised when I left my W-2 about how much mind share there was being taken up by that job and how much you really need for the real estate side. So when I was able to shed that, it allowed me a lot more, again, mind share for problem solving and administrative thought and really motivation, right? Because a lot of what we do is grueling and somewhat tedious in a lot of ways. And so when you don't have the motivation to get up in front of your computer and try to do something that's going to affect the next 5 years of your life, but it doesn't affect tomorrow, you need some motivation to do that stuff and wake up and do that on a daily basis. So where you're W-2, it's like if you don't do that thing today, it could affect you tomorrow, right?
Yeah.
And so being able to focus more on long-term strategy was really just eye-opening and just freeing for me to focus on that more.
Because that's a great point. I cannot stress that enough. It's the investor mindset. It's an entrepreneur mindset of putting in the work now, knowing that it's going to pay off or hoping it's going to pay off. It's like a bottle of bourbon. I don't know. I was talking to my buddy the other day about bourbon. And then they make it and then you have to wait years and years. And then did it make the trip? Is it good? So it's kind of like that. How do you slow yourself down now to make those strategic decisions?
Good point. So yeah, I mean, slowing yourself down, that's a good way to look at it. I'm not great at goal setting. Sometimes have the 5-year or 10-year goals, but I think like a 10-year goal for me is almost useless. Like that, what's actionable about that is tough. So I try to break my goals down a lot sooner, at most maybe a year. Like, where do I want to be in a year? Because I think things change too quickly in our environment to try to assume that whatever our goal is today is applicable in 3 years or something. But that's just me. I think a lot of people work well on goals, but goals are all about motivation. And I think my motivation for the long term is there. So now it's a matter of the steps to get there. And so finding out what are the interim steps, who do I need to be meeting and working with? A lot of my business is connecting with not only passive investors, but connecting with other potential active investors that bring in investors to the project, right? Because we mostly do 506B offerings, which for those that don't know is the SEC exemption that your investors need to have a previous and substantive relationship with the investor and the operator, right? So that needs to exist before the offering is presented. And so with that, we need to make sure that our goals are aligned with between me and the investor or me and the partner and the investor before anything happens. So we need to meet those people before we find the deal. And so that's a big part of connections that I'm trying to make as well right now.
Yeah. So, and you alluded to this a minute ago too, is just, I had to put it down, your daily activities. So you're like, I ain't got no job, no boss. It's me. You're rolling around in your skivvies all morning. So what do you do now? Like, how do you plan your days, and like, what are your KPIs are? So key performance indicators. And so like my business, I've got a whole sheet for Ridgeline, like all the things that I need to be doing. What are your KPIs now that you're on your own? We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com.
Since I'm still a little new to doing this full time, before it was almost survival. I did everything I could whenever I could and just kind of drive towards what I thought was the horizon, right? And so that is something that I'm working on. Like, what are my KPIs? That's one of my tasks is identifying those things. What are the things I need to do to get me to the Holy Land, if you will? So my day-to-day activities are completely different from one day to the next. And I think it's a lot based on my motivation for that day. So some days I'm very effective in what I'm doing. I can get a lot done in those days and connect with some people. But what I'm trying to do right now is network and try to meet more and more people to try to work on the business with. So on the more, I guess, active side of things, not the networking side, but the actual work side, I'm able to take an offering pretty quickly from a broker, analyze it, and see if that's going to meet the needs at various levels of that process. So early on, you do a quick analysis and see, hey, is this even in my buy box? And you might go tour the property and start bringing in some of those vendors and third-party relationships to try to figure out how that works. So if that comes in, that throws off your whole day. I've got to focus on that, and I want to act quickly on it, right?
Yeah.
Where I might have something scheduled, but it's less priority. So time blocking is a big thing that I try to do, and have things that are recurring or maybe one-off things that are going on. Put that in my calendar so it's like a personal assistant telling me what I need to be doing at any given time. And if I have big blocks between tasks or things I need to do, I got to enjoy this time a little bit too. I think, especially right after working for 17 years, I know that's not forever, but maybe I'll go hit a golf ball. Maybe I'll go like clean the dishes or something, right? Do something that can help my personal life, either entertaining activities or something that needs to be done around the house. I do have that freedom now. So when I'm not terribly motivated on the real estate side of life, maybe I do something different today. So then tomorrow I know I can hit real estate hard.
Yeah.
So
yeah.
Day-to-day activities change.
For sure.
And I don't have great KPIs to track at this point, but
yeah,
most of it's around how many people I want to meet on a monthly basis.
Yeah. And that's one of the things. Like, we had a consultant come in when we were doing the single family stuff, and we were implementing traction. And so they came in, they were talking to us.
Yeah.
And like, one of the things that keyed in with me that always sticks with me now, it's like, right now you have marketing. I know kind of your structure and your setup and what you got, but right now you live. And if I looked at your org chart, it's like Kenneth is everywhere. right? That's the same way I'm structured, right? But you have third parties that come in, they help, they do certain things. But where I'm going with that is what the implementers told us. And the way I look at it now is like, what is the money ball, right? That's the analogy. If you've seen the movie and watched, like, what is each position's money ball? And that's all that needs to be reported on. And it should be one activity, right? So I'm always curious. I always ask people that because I feel like I have 6,000 activities that need to be done. Again, I'm like, how do you slow down to like take this step back and be like, okay, the 10-year, it may be just like a vision. It's not like a goal, but it's like, this is where I'm going. This is why I did this. So today I need to work on X, Y, and Z. But yeah, man, do the dishes. Enjoy. Sometimes I take that for granted.
We're all ordinary people. Yeah. We're just living our lives and doing regular stuff. But yeah, just the focus is different. And I think that's what it's about is priorities, right? How do you set your priorities? I've had to grow so efficiently in what I'm doing. Most of the things that I build, I either don't do or I build efficiently. I don't tend to try to build processes that are terribly complex that need a lot of my time and attention. And if you're building that from the start, then you don't fill up your time and then have to kind of work on it to make it more efficient. I just build it hopefully efficiently the first time. And that's mostly because I connect with people who have done it before and I mimic their process, right? That type of thing. And so I haven't had to hire a VA or some kind of other partner, third party stuff too terribly much, which is helpful. Like I use third parties in the way that they're intended for the operating kind of purposes, but not really for time saving. It's more for expertise in their field. It's kind of nice when you're doing the financial analysis on like hiring a VA, they have to take things off your plate for things that you don't have time to do. And for me right now, I kind of do have that time to be able to even work on administrative things at this point. So I'm doing a lot of that myself because I don't want to hand it off to a VA when my alternative, what I'm doing in that time that I wouldn't be doing the administrative thing isn't valuable, right? It would be personal time kind of stuff. And that's nice. It's not income producing in a lot of ways, right?
Yeah. Or expense reduction. Yeah. If you're adding somebody some cost to it. Okay. So let's talk about a deal now. So you kind of talked about it a minute ago and I wanted to dive into like a specific deal, maybe not the most recent, or it could be whichever one you want to talk about, but just kind of curious. I know how you structured it. You were working, and so then you found capital partners to come in, right? And that's like a big strategy that you implemented so that you could focus on the actual property and being a lead sponsor just from the get-go. So can you talk about maybe one of the deals, let's pick one, and just tell us how it came about, how you got the deal, how big it is, some of the specific deal junkies out there. We all like to hear a deal.
So let's dive into my first deal.
Okay.
That was one of the more hairy deals. So it's fun to talk about this. So a little bit of backstory. About 6 months before I ended up buying this deal that we're going to talk about, I was under contract with a 132 unit that ended up having a fire after we had got into the contract period. We were doing our due diligence and like 12 units burned down of 132. And sometimes that can be not necessarily a negative. There's a lot of silver lining in a situation like that. But for me, since my first deal ever, the complication factor was too much for me. And I couldn't really do the trigonometry required, the financial, like all the movement that would happen when that happens in the middle of acquisition. For my first deal, it's got to be a little bit more straightforward. So we ended up exiting that contract. But the reason I tell you that is that broker was like, hey, man, I want to get you in a property. I feel bad about this. I mean, it wasn't his fault, of course, but he's like, I want to get you into a deal. And so we looked again for the next 3 or 4 months real hard and found the deal that I ended up buying. It's a 176 unit and it's in kind of the central south San Antonio, but it's in a pretty nice pocket, I think. Yeah, it's an older asset. It's an 60s asset, late 60s and Class C asset, nice working class community. And when I was going to buy that, the big thing that I learned through a lot of my education process and the mentorship programs that I'd been through is that you need partners, right? This isn't something you do alone. So I wouldn't have gone after 176 unit if I didn't have those structure and those partners with me. That was one of the big things I did. I partnered with other partners who could bring investors to the table, amongst other things, and kind of help us all kind of get there. Guaranteeing the loan was a big part of this. We're having a $15 million loan. Are they going to give it to somebody with no experience and a lower net worth. It's like, no, you need a higher net worth. You need some experience. So I partnered with somebody to bring that as well. And so you just kind of put all the pieces together, and the acquisition part of the process is really more like a project manager in a lot of ways. You might be expert at like putting all those pieces together, but each piece is something that somebody else does better than you or better than me. And I was okay with that. That wasn't my role. So putting all those pieces together, we ended up buying the 176 unit. It was a $4.2 million capital raise. And so myself and my partners all found our investors, brought them to the table, and we were able to raise all that in about a month, which was great. This was in December of 21 is when we actually closed. So one of the things that was tough about this was closing at the end of the year. There was a lot of people who were saying, hey, I need those K1 losses for that calendar year. So we wanted to place all that capital technically in 2021. So for those of you who don't know, the tax incentives or bonuses that we get because we're doing real estate a lot of time, and you'll have to talk with your own CPA. I'm not a CPA, but talk with your CPA about how these deals can potentially, even though they're making money, have depreciated losses where your statement, your tax statement that we give to you says that we depreciated the property faster than it made money, and you actually get a capital gains loss or a capital loss that can potentially offset a capital gain that you had somewhere else, right? So that helps us be tax advantaged in that way. So we wanted to close in 21. Well, we ended up closing on like December 28th or 29th or something of 21. It was crazy to try to get it in on time. We then bought the property and then started going through our bottom out period. So after starting to operate it and go through it, we found that the financials and the reports that were coming out weren't quite as rosy as we had been led to show what the property really was doing. So we ended up having to bottom out the property a lot more, which means taking the tenants that were not meet our requirements based on what kind of job or if they had a job, what their income levels were, that type of thing. A lot of the tenants weren't qualified to be at that level. So having to thin out some of the tenants and bring in newer, more qualified tenants into that space. And that took a pretty good dip. I mean, we were down to, I think, in the high 60s or so. Occupancy, thank you.
Yeah.
And so when you dip that low, cash flows are tough to come by. You're still having to operate the property at that high level, but your income is much reduced. So we bottomed out, came back up. Now we're in the 90s again. So we're stabilized after, I guess now, I mean, it took about a year, a little less than a year to fully stabilize that property. But now we have qualified tenants. We have cash flow coming in. We're renovating the property like crazy. So we're adding a lot of value to it. But at that time, that was tough to kind of go through that bottom out period.
Yeah. Did you have a big like per unit CapEx that you were going in and they were classic units, you were going to update them?
Exactly. So to the investment is that we're taking a kind of a classic unit, something that already exists. Maybe it's being rented. Let's say it's rented for $700. And we go renovate the property. Maybe it's $5,000 to renovate the property, make it look better. And we can rent it for $900, right? So that $5,000 investment now has a $200 a month premium on it, and you can do the math and compound it out, and you're adding value to the property because your overall rents coming in are higher, your income is higher. And that's how these properties are evaluated. They're not like single family, right? Where it's more about comps and, hey, this is a 3-bedroom, 2-bath on the same street. There's really no direct comparisons a lot of times for these apartments. You can't evaluate it like that. It's evaluated more like a business or valued more like a business where it's based on the net operating income, and that you can really control a lot better than you can like, hey, does this look like the property down the street? That doesn't really matter. It's more about the business and how the income is coming.
Yeah, it's the income approach on that. I was going to say, if you do the math on that, just that scenario, if you're investing $5,000 a door and you get a $200 rent increase on that, it's a 50% ROI on those invested dollars. So it's a pretty solid return on those invested dollars. And then, as you alluded to, you're increasing the NOI, and it's a multiple on the back end of the value that's actually created. So the reason I was asking that question, though, in this deal specifically, is because if you had planned on, I guess, renovating most of those units, if your occupancy dipped to 60, you just had 40% of the property, you're able to push those renovations a lot faster, I would imagine. So you're getting to your pro forma numbers a little bit faster.
Absolutely. So our limiting factor was capital at that point. So when you're renovating these properties, the way that these loans work, and we're in a bridge loan, which is a kind of a product that is like a private equity fund, and they will fund up a certain percent of the purchase price. and do that up front, right? So similar to a house mortgage where they're going to fund, say, 80% of the deal, and you have to come up with 20% of the down payment, right? Then they also fund your capital improvements. So if you assume that you're going to spend, say, $1 million on improvements, they have that agreed upon that you can use up to $1 million and just add that money to your loan whenever you need it. The problem is that the property has to do the renovation first and pay for it. And once it's all paid for, all the liens are released, then you go apply for that capital to come back to you. So you need some working capital to actually complete the renovation before you can get reimbursed for that money. So we're not talking about unlimited capital that we can just go renovate 40% of the property during that year. That would have been really nice. We could have gotten a lot done. But the problem is, we had to have the capital to kind of cycle through and get reimbursed and do that even when we were cash flow starved. So that was some financial juggling to make all that work. And then once we were able to kind of work through that process, then we're cycling through. So some months we're renovating 3 or 4 units a month, which is a pretty high rate for 176 unit, which was nice. Normally we were looking at probably 2 or 3 in a month. So 3 or 4 is an aggressive pace. So that was great to be able to have. Anytime we had the capital to renovate a property, we would do it because we had it available. And now we're less so. Like, we don't have unlimited units available, but we're still being able to cycle them at a pretty good rate to keep that trajectory, that momentum going. Yeah, that was a weird time to kind of go through, certainly.
Yeah, man. I mean, that deal it's interesting. Again, and you're on bridge. I mean, we could talk about all that stuff. You mentioned cost seg as well. Just wanted to say, we discussed that at length on episode 20 with Yona Weiss. He's cost seg king. So if you want to go back and listen to that episode and learn more about cost seg, it's a great place to get that information. And then we are getting close to the end, man, but I wanted to ask you, because this is a big thing. Again, when you got in, you focused on building the relationship side of capital partners coming into your deals so that they could focus on underwriting and finding and acquiring, right? Contracting, get them locked up. So what is a conversation like with potential capital partner who's going to come into you? Like, how do you source them? And then 2, like, what's in it for them and why would they want to come into a deal like that with you?
Yeah. And also a little side note, we worked with Yona Weiss, Madison Spec on these last couple properties. So good vendors to work with. He's good at explaining the process. One of the big things is they're not just capital partners, right? That's the main thing. You've got to come in and be a part of the project, right? These aren't securities brokers kind of people that are like financial analysts or financial planner. They're really a true partner on the deal, right? That's the biggest thing. They understand the deal. They've walked the deal. They maybe gone through due diligence. And so when you're trying to find somebody to work with, you need somebody that isn't just going to pay check, or they're not just a checkbook. They're really part of the process, right? And so they can bring some experience, things like that. I meet these people all over the place. So a lot of times it's through conferences or masterminds that I'm a part of or relationships that I've fostered. It's hard to just meet somebody off of LinkedIn or something and say, hey, this is what you do, right? You need to have a strong relationship with them because, you're getting into a deal with them. You're sharing equity. You have a lot of trust there that you've got to build for this project. So it's really important that you can work with them on a long-term basis and that you like to work with them. They like to work with you. You have shared principles, shared values, and that they can also offer more than just, hey, I've got some investors, right? They need to be more substantively part of the deal. And that's an SEC thing as well.
For sure. Yeah. Awesome. Well, Kenneth, love the info and I love what you're doing. Congrats again on quitting the W-2, having free time to do some more dishes. Thanks. Hanging out with the family. Before we go, look, I ask sometimes I don't, but I'm just kind of curious. Let the listeners let us all get to know Kenneth a little bit better. Like, what's your favorite pastime? I heard you mention hit some golf balls. You and I need to go play some golf, apparently. What else do you like getting into?
Yeah. And I hadn't picked up a club in like 5 years. So it's been nice to get back into it a little bit and got a coach to kind of get me back in the motion. So that's been nice. In the past, I kind of collect hobbies. I'm into woodworking. I was a sailor back in college. So I still like to go on the water a little bit, go sailing. But right now with 2 young kids, I've got a 3-year-old and a 5-year-old. That takes up most of my free time.
Yeah. We have the same age. That's great. On that point, what's the best thing that's happened to your family in the last month or 2?
So I just built a new play structure for them last week. So I went to Costco and got one of those build-it-yourself kits.
Yeah.
And so they've been really enjoying
awesome.
that. But my eldest is about to get into kindergarten. So kind of crazy times. Yep.
Yeah, man. Yeah. Kellen just finished his first year. So yeah, it's a big move. And it's great to see that their faces light up. They're like, I'm a big kid. I'm going to school. So awesome. Cool. All right, man. Well, hey, it was good catching up. Thanks for sharing your knowledge, your experience, your information. If anybody wants to reach out to Kenneth directly, his info is going to be in the show notes. And we're going to catch you guys on the next episode. Bye-bye.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.